On August 15, 1947, a flag was lowered in Delhi. It was quiet. No battle. No treaty signed at gunpoint. The British Empire, the richest empire the world had ever seen, walked away from its most valuable possession. Not because it wanted to, but because it could not afford to stay. At that moment, Britain was drowning in debt. Its national debt had climbed above 200% of its economy. Its treasury was empty. Its cities were exhausted from war. World War II had broken the illusion of endless imperial wealth. For nearly 200 years, India had funded Britain's rise. Taxes, trade monopolies, forced production, cheap labor, and now that engine had stalled. Most history books frame this moment as a moral awakening. They describe independence as a gift, a graceful exit. Archived records suggest something very different. This was a financial retreat. Britain did not lose India on the battlefield. It lost India on the balance sheet. When the money stopped flowing, the empire stopped working. In London, officials reportedly knew the truth years earlier. Without India's revenues, Britain could not pay its debts. It could not maintain its military. It could not stabilize its currency. The empire had become too expensive to operate, and this raises an uncomfortable question. If the richest empire in history collapsed because of greed and overreach, what does that say about power today? To understand how Britain reached this point, we have to go back, not to independence, not to war, but to a quiet decision made centuries earlier when profit first replaced restraint. The real story does not begin with independence. It begins long before Britain ruled India directly. It begins on December 31, 1600. On that day, Queen Elizabeth I signed a single document in London. It granted exclusive trading rights to a small group of merchants. They called themselves the East India Company. At first, the company looked harmless. It traded spices, textiles, tea. There were no armies, no colonies. No talk of empire. Just profit. The company promised something powerful. Private wealth without public responsibility. Its investors were protected. Its risks were shared. Its losses were quietly absorbed. According to archived records, early shareholders saw it as a safe bet. Trade was risky. But monopoly made it manageable. One company, one charter. No competition. That detail is easy to miss. But it mattered more than any future battle. Because monopoly changes behavior. When profit is guaranteed, restraint disappears. By the early 1700s, company officials were no longer just traders. They negotiated with local rulers. They collected fees. They interfered in succession disputes. A former company clerk later wrote that business meetings felt less like commerce and more like government. Ordinary people in India noticed the shift first. Prices changed. Local markets tightened. Taxes appeared where none had existed before. This was not conquest yet. It was influence. And influence is cheaper than armies. Few people at the time believed this company would rule millions. It did not look like power. It looked like paperwork. But paperwork can reshape nations. And once profit became the organizing principle, the path forward narrowed quickly. So here's the question worth asking. When a private company gains political power without accountability, who pays the price? The answer would emerge slowly. And by the time it was clear, it was already too late. The first real shift came in 1757. It happened far from London, on the plains of eastern India. The event was the Battle of Plassey. On paper, it looked like a small military encounter. A few thousand soldiers, a brief confrontation. In reality, it changed the global balance of power. The East India Company was led by Robert Clive. Opposing him was the Nawab of Bengal, one of the richest rulers in the subcontinent. According to archive correspondence, the battle was decided before it began. Company agents had already bribed key generals. Promises of money mattered more than loyalty. When the fighting ended, the company did not just win land. It won revenue. After Plassey, the company was granted the right to collect taxes in Bengal. Later, that right expanded to Bihar and Orissa. This was the moment everything changed. The company no longer needed to trade fairly. It could simply tax. 30 million people now paid money directly to a private corporation. One of the richest regions on Earth was no longer funding its own future. It was funding shareholders thousands of miles away. Local merchants noticed the difference immediately. Cash drained from markets. Silver disappeared from circulation. Company officials reportedly lived like princes. Lavish homes. Private guards. Enormous personal fortunes built in a few years. Back in Britain, few questions were asked. The dividends were too attractive. One retired officer later admitted that the company had crossed a line. It had stopped behaving like a business and started behaving like a state, but without the responsibilities of one. This shift did not look dramatic at first. No flags were raised, no empire was announced. Yet power had quietly changed hands, so here is the question. When taxation serves profit instead of society, how long can any system last? The answer would unfold slowly. And it would not stop with Bengal. Once the company gained the right to collect taxes, the system revealed itself. This was no longer trade. It was extraction. The East India Company created a simple loop. Taxes were collected in India. The money was sent to Britain. Very little came back. According to archived records, revenue from Bengal alone exceeded what Britain raised from some European territories. But this wealth did not build schools. It did not improve irrigation. It did not stabilize food supply. It was transferred. Company officials fixed prices for key goods: salt, opium, textiles. Indian producers were forced to sell at rates far below market value. In some regions, prices were set nearly 40% lower than what open trade would allow. Weavers felt this first. Families that had produced fine cloth for generations suddenly earned less than subsistence wages. Many fell into debt, others abandoned their looms entirely. A former company officer later wrote that contracts were enforced by fear rather than law. If producers resisted, taxes increased. If villages protested, credit disappeared. This was the mechanism. Control the tax system. Control pricing, control credit. No armies were needed most days. Ordinary people noticed something else. Food grew scarce even in fertile regions. Not because harvests failed, but because cash crops replaced grain. Opium fields expanded. Cotton replaced rice. The company did not see famine as a failure. It saw it as a market signal. Taxes were still collected during shortages. Relief was minimal. Records show revenue targets remained unchanged. This was not accidental. The system rewarded short-term gain and punished restraint. Back in Britain, profits appeared clean and impressive. They arrived without context, without faces, without consequences. So here's the question to consider. When a financial system rewards extraction but ignores survival, what outcome should we expect? The answer would arrive quietly, not as collapse at first, but as something slower and far more devastating. By the late 1700s, the effects of Britain's extraction began to show in stark numbers. The Bengal famine of 1770 reportedly killed between 7 and 10 million people. According to archived records, taxes continued as usual. Relief efforts were minimal or absent. Farmers and weavers faced ruin. Those who had produced the finest fabrics in the world were forced into bonded labor. Entire villages emptied as families fled or perished. Ordinary citizens began to realize the consequences of unchecked corporate and imperial power. Local markets shrank. Food shortages became more frequent. Debt spread across entire regions. Meanwhile, in London, shareholders celebrated record profits. The East India Company's dividends soared. No one on the other side of the world counted the human cost. One personal account from the period tells of a young weaver in Dhaka who watched his family's livelihood disappear. He reportedly abandoned weaving and migrated to the countryside, hoping to survive by farming marginal land. The contrast was staggering. Millions suffered silently, while Britain's coffers swelled. The question to consider is simple yet profound. When wealth flows in one direction only, what happens to the communities left behind? And when the drain continues for decades, how long before the system itself begins to crack? The answer was not immediate. It unfolded slowly, but its consequences would eventually reach all the way to the heart of the empire. By the early 19th century, the pressure had begun to compound. What started as extraction slowly turned into dependence. Britain no longer just benefited from India. It relied on it. Taxes from India helped stabilize Britain's currency. Indian revenues paid interest on British debt. Indian labor supported British wars far from Asia. According to Treasury records, a large share of Britain's overseas spending was indirectly funded by Indian taxes. This created a dangerous feedback loop. The more Britain spent, the more it needed from India. Railways expanded rapidly after 1850. They were presented as development. But the financing told a different story. India borrowed the money. India paid the interest. British firms received the contracts. Steel, engines, rails, all imported from Britain. According to archived agreements, many railway projects guaranteed British investors fixed returns, even if the lines lost money. The risk stayed in India. At the same time, military costs rose sharply. The Indian army grew larger each decade, not to defend India, but to protect imperial interests. By the late 1800s, maintaining this force consumed a significant share of India's revenue. A British civil servant later admitted that India paid for an army designed to control itself. Ordinary people felt the squeeze everywhere: higher taxes, more land assessments, less food security. Small farmers reportedly sold livestock to meet tax deadlines. Some sold land that had been in families for generations. Yet from London, the numbers still looked healthy. Budgets balanced. Trade appeared strong. Confidence remained high. This illusion mattered. Because it encouraged even greater expansion, India was now tied to Britain's global ambitions. Wars in Europe, conflicts in the Middle East, naval power across oceans. Each decision added another layer of cost, and every cost flowed back to the same place. India had become the financial shock absorber of the empire. So here's the question worth asking. When one system is forced to absorb every strain, what happens when the strain becomes too large? The answer would not come all at once. But the pressure was building. The system finally cracked under the weight of global war. The first fracture appeared during World War I. India supplied men, money, food. More than 1 million Indian soldiers were sent overseas. Many never returned. India also paid for the war. According to archived finance records, much of the cost was charged directly to Indian revenues. When the war ended, Britain emerged victorious. But it was weaker and more dependent than ever. Then came the second shock. World War II pushed the imperial system past its limits. The Indian army expanded to more than 3 million men, the largest volunteer force in history. Britain could no longer pay in cash, so it paid in promises. These promises became known as sterling balances. They were debts Britain owed to India. Debts it had no clear plan to repay. By 1945, India had become one of Britain's largest creditors. At the same time, food shortages worsened. Shipping was diverted. Supplies were redirected. This led directly to the Bengal Famine of 1943. Between hundreds of thousands and several million people died. Not because food did not exist, but because it was moved elsewhere. While people starved, exports continued. According to cabinet records, requests for emergency relief were delayed or denied. Winston Churchill reportedly viewed the crisis as a logistical problem, rather than a humanitarian one. Indian officials on the ground saw something different. Entire villages emptied. Markets collapsed. Families sold everything they owned for a handful of grain. This was the moment confidence broke. Not just among the public, but inside the system itself. Britain was running out of money, running out of food, running out of credibility. Its debt now exceeded twice the size of its economy. Its currency was under pressure. Its empire had become unaffordable. For the first time, officials in London quietly admitted the truth. India was no longer an asset. It was a liability they could not manage. So here's the question to sit with. When a system depends on endless extraction, what happens when the source can no longer give? The answer was no longer theoretical. It was already unfolding. When historians look back, a pattern becomes impossible to ignore. The British Empire did not collapse because it lost control. It collapsed because it lost balance. From the beginning, the system followed the same logic. Extract first. Delay repayment. Expand further to cover the cost. This pattern repeated across centuries. In the 18th century, it was taxes from Bengal. In the 19th century, it was railways funded by Indian debt. In the 20th century, it was global wars financed by colonial resources. Each phase solved a short-term problem and created a larger long-term one. According to economic records, Britain's share of global output rose sharply during peak extraction years. India's share fell just as sharply. This was not coincidence. Wealth did not disappear. It moved. The same institutions that reported prosperity in London recorded stagnation in Calcutta. The same ledgers that showed growth in Manchester showed decline in Indian manufacturing towns. This is the hidden pattern. Empires often mistake cash flow for strength. As long as money arrives, the system appears healthy. But extraction weakens the source. When investment does not return, productivity collapses. When productivity collapses, extraction must increase. And when extraction increases, resistance grows. The pattern has appeared before. Spain relied on silver from the Americas. Portugal depended on colonial trade monopolies. The Netherlands overextended its commercial empire. Each believed its system was permanent. Each ignored the warning signs. Britain followed the same path, only on a larger scale. By the 1940s, India was no longer generating surplus. It was absorbing loss. That shift mattered more than politics, more than protests, more than negotiations. Because once the numbers stopped working, the empire had no anchor. So here is the deeper question. If power depends on constant inflow, is it truly power at all? The answer explains not just the past, but why similar systems continue to fail. And why the end often feels sudden, even when the pattern has been visible for generations. When Britain left India, the damage did not disappear. It remained embedded in institutions, infrastructure, and habits. In 1947, India inherited an economy shaped for extraction, not growth. Industry was weak. Education levels were low. Public health systems were fragile. Life expectancy at independence was around 27 years. Illiteracy was widespread. Capital was scarce. Yet something else changed immediately. For the first time in centuries, revenue stayed inside the country. Within decades, indicators began to move. Life expectancy more than doubled. Food production stabilized. Domestic industry slowly returned. These improvements did not come easily. They required decades of adjustment and policy experimentation. For Britain, the consequences were different but just as lasting. Without India's revenues, the empire could not sustain its global reach. Military commitments shrank. Colonies across Africa and Asia followed the same path. By the 1960s, most of Britain's overseas territories were gone. The empire that once controlled a quarter of the planet had dissolved quietly. According to post-war financial records, Britain relied on large loans from the United States and Canada to survive. Some of those debts were not fully repaid until the early 21st century. The loss of empire forced Britain to redefine itself, from imperial power to regional economy. The pattern did not end with Britain. Modern financial systems still show similar traits. Heavy debt. Global obligations, dependence on external inflows. The structures look different, but the logic is familiar. When prosperity is built on imbalance, the cost appears later. And it is often paid by those who did not benefit in the first place. So here's the question to consider. When history leaves such clear evidence, why do so many systems repeat the same mistake? The answer may lie in the final lesson Britain's empire left behind. By the end of the Second World War, the numbers told a story Britain could no longer ignore. Its national debt had grown to more than twice the size of its economy. Exports had collapsed. The currency was under strain. The empire that once financed everything had become a cost it could not carry. On paper, independence was framed as transition. In reality, it was retreat. Britain did not leave because pressure became uncomfortable. It left because the system no longer worked. Greed had delivered growth quickly. But it had also hollowed out the foundation. Extraction replaced investment. Control replaced partnership. Short-term gain replaced long-term stability. When India's revenues stopped flowing outward, the illusion of strength disappeared. The empire's power had always depended on imbalance. Once that imbalance corrected itself, collapse followed. This is the part history often softens. Empires rarely fall from a single mistake. They fall from habits. Habits that reward taking more than returning. Habits that ignore sustainability. Britain's rise and fall offers a quiet warning. Wealth built on exploitation does not compound forever. It reaches a limit. And when that limit arrives, the fall feels sudden, even if the cause has been decades in the making. So here is the final question. If the richest empire in history could not escape the cost of its own greed, what does that suggest about power in any era? History often presents empires as strong until the very end, but the truth is quieter than that. They weaken long before they fall. Britain's empire did not vanish overnight. It faded as its foundations eroded. Debt replaced surplus. Extraction replaced renewal. What remained was not conquest but consequence. For generations, wealth flowed in one direction. And when that flow stopped, nothing was there to replace it. This is not a story about blame. It is a story about limits. Every system built on imbalance eventually meets resistance. Sometimes from people, sometimes from numbers. Often from both. The collapse of the British Empire reminds us that power is not permanent. It must be maintained. It must be balanced. And it must be paid for. So here is a final thought to leave with you. When prosperity comes easily, do we ever ask who is carrying the cost? And when we do not ask, how long can that prosperity really last? If you enjoy stories like this, quietly unpacking the forces that shape our world, you may want to explore more episodes here on the channel. Thank you for watching.